Hello bro, and welcome back to the new stock evaluation video. So today we are going to analyze this company called Altria Group Incorporated with the stock ticker MO. And the reason why we will analyze this company is because all of the dividend investors on the internet, they all have this stock in their portfolios. It's actually, according to them, one of the best dividend stocks, probably because it has extremely high dividend yield. So bro, I decided that I will analyze this company with you, and then based on that we will see if we should also add this stock to our own portfolio, okay? So as always, we will analyze this company based on my Excel table that I prepared right now here. And as always, we will also follow the 3 rules that I established. So the first rule is that we will analyze the data for the last 10 years. And then based on that data, we decide whether we should buy or sell the stock. And the third rule is that we will always take a look at the good things first, then the bad things, and at the end, based on all of the data that we analyzed, we will have a final decision, okay? So I also noticed, bro, that my videos are quite repetitive and quite boring, so I decided to make this presentation or this video a bit more engaging. So I prepared here a little Canva presentation that we will use to present the data and make it a bit less nerdy, okay? So let's go straight into it. So the first good thing is that the gross profit is growing. So what does actually gross profit means? So gross profit is actually the profit after the costs, okay? So the company gets some amount of money, okay? And then you make that money minus the costs and you get the gross profit. So you basically deduct the costs of the whole cash that company gets, and then you have the gross profit. It's actually the profit after all the costs, okay? So it's growing, so that's a good sign. Another good sign is that the operating income is growing, and operating income is actually the future income. So this income right now here will at some point in the future become part of the whole cash that the company gets. So if the operating income is growing, that means that also the future income will grow as well. And another good thing is that the dividends are also growing through the whole years. So that's why probably this company is so popular among dividend investors, because it has dividend yields. And this is probably the reason why this company is so popular among dividend investors, because the dividend yield is extremely high and the dividends are growing. So of course they have more and more cash each year. So that's an amazing sign for dividend growth, okay? Another good thing is P/E ratio. So what does P/E ratio actually mean? In our case, let's say P/E ratio is 9 or around 10. Let's say it's 10, okay? That means that we have to invest 10 euros into Altria Group to get 1 euro profit. P/E ratio actually tells you how much money you have to invest to get 1 euro profit. So preferably, bro, we want to invest into companies that have P/E ratio below 15, because that means that those companies don't require that high investment to get that same dollar, okay? So this company has around 10 P/E ratio, so it is below 15, what we want to see. And the good thing is that it's also below the P/E from competition. So here I calculated the average P/E ratio out of top 8 competitors, and their average ratio is 12. So the current P/E is around 10, so it's lower than the one from competitors, and also the one that we established by 15. So that's an amazing sign. And another good sign is intrinsic value. So what does intrinsic value actually mean? So right now the stock is trading at $46. So the stock costs $46, okay? But based on some calculations in the background that are a bit complicated, the fair price should be 76. Right now the company, based on all of the financials that it has, right now the company should have this price, 76, instead of 46. So because the fair price is higher than the current price, that gives us the difference of $30, which means that if the fair price is higher than the trading price, the company is actually $30 undervalued. So that's an amazing sign, okay? And now, unfortunately, we have to come also to the bad things, and the bad things are that the total revenue and net income are completely inconsistent. So what does total revenue actually mean? Total revenue is literally the whole cash that company gets in 1 year, okay? This is the whole income, literally every cash that company gets into its pocket, okay? And then net income is calculated like this. So you have total revenue minus gross profit is then net income. So net income is actually the whole cash that company gets with total revenue minus the costs, minus additional costs, and then you have the net income. And we want to see net income growing through the all years and also total revenue growing through the all years. But here you can see it goes up and down, and also net income is even in minus, which means that here they had more costs than money coming in. So that's a very bad sign. And another bad sign is retained earnings. So retained earnings are actually all of the monies that the company invests back into itself to buy new equipment, new machines, basically to expand the business, okay? And we want to see this growing through the all years as well, because if the company reinvests more and more money into itself, that means that they are trying to get the competitive advantage, okay? Because if the company doesn't invest into itself, they will not grow, they will not produce something new. So that's a very bad sign. And you can see that they were actually investing quite a lot into the company back, but now it stopped growing and even started to fall. So that means that they are not investing that much money back into themselves, okay? So it's a very bad sign. Another bad thing is return on equity. So this actually tells us how much profit does the company has. So here you can see in the early days, it had 150% profit, then almost 200 right now here. Then here it was negative. Then here in 2020, it was 150% and so on and so on. You know the drill. So basically right now, the return on equity is in minus. That means that the profit is also in minus, which is extremely bad, because that means that they have more costs than they have the money coming inside. And you can also see that here on the debt to equity ratio, which actually compares the debt with the whole money that the company has. And you can see that the debt to equity is negative. Now, what does that mean? That means that they have more debt than they have cash. So they have more costs in the future than money coming in. And this is completely unsustainable, because if this continues in the future, they will not have cash to repay that debt. You know what I mean? And this will make them completely destroyed. So what we actually find out, so here is the quick summary. The company has good things in terms of the growing gross profit and growing dividends. It is also undervalued. That means that it's actually cheaper than competitors based on P/E ratio and intrinsic value, which is actually the fair value. But it has inconsistent financials. It has extremely high debt, which is higher than the cash that they get. And it has slower reinvesting, as you can see right now here. So now let's go to the final evaluation. And for the final evaluation, we will use here a little checklist that I prepared. So we will basically decide based on those questions, yes or no, and then see if we should buy or sell the stock, okay? So is company growing? No, it's not, because you can see, for example, here you see the total liabilities are up, total equity is up. Here total revenue is messy, net income is minus, and so on and so on. So company is not growing. Are the margins preferable? No, because we want to see, for example, gross profit margin higher than 40%, which it is, but net income margin is but net income margin was at some point actually negative, which means that they had less money than costs, which is the bad sign, okay? Then is debt decreasing? No, because it's increasing. As you can see right now here on this graph, it's high, extremely high. Is company reinvesting? Yes, but slowly, so it's still no. Are dividends growing? Yes, they are. Is P/E below competition N15? Yes, it is. Is price undervalued based on intrinsic value? Yes, it is. And is price less than 150 euros or dollars? Yes, it is. So the final evaluation is actually to sell this stock, or at least not to buy it. And I agree with that, because as you can see right now here on this presentation, total revenue is completely inconsistent. Net income was in minus. They have more debt than ever. They have more loss than ever. They don't invest back into itself. So it's bad. So it's, in my opinion, bro, I wouldn't buy this stock. I would wait that they try to do something to solve the situation. Even though it has high dividend yield, I wouldn't buy it at all. So bro, now you know what to do. Do the hard work. Subscribe if you want to know more about stock market investing and self-improvement. Join me on this amazing journey so that we can get rich together. Do the hard work and see you on top of the world.